Welcome to vTalkInsight, Market Drivers Daily for December 4, 2025. AI Capex, a steepening yield curve, and rising geopolitical strain are colliding to reshape risk and return across public markets. Let us start with how the AI boom is evolving, from pure growth story to a more complex macro and credit narrative. The AI theme is moving from a simple growth story to a more demanding phase where capital efficiency, credit risk, and duration all matter a lot more. Recent days have reinforced that AI remains the main macro engine, but they also highlight a growing gap between massive investment and still nascent monetization, which markets cannot ignore indefinitely. On the numbers, returns on generative AI capital spending are currently estimated at about 20 cents for every dollar invested, compared with roughly $1.40 during the early cloud build-out. At the same time, only around 3% of United States companies have actually adopted AI, which underscores just how early the enterprise cycle is and why revenue is lagging the infrastructure build. Despite that mismatch, demand indicators remain strikingly strong. Marvell Technology is guiding for up to 25% growth in data center revenue next year and has lifted its 2026 outlook by a quarter while spending $3 billion to acquire Celestial AI, and demand for NVIDIA chips is reportedly outstripping supply by roughly 12-1, pointing to persistent bottlenecks in AI infrastructure. Equity markets are responding with growing dispersion rather than a one-way rally. Stocks linked to alternative AI stacks, such as Gemini and Tensor processing unit ecosystems, have been outperforming, while names more associated with the traditional GPU and ChatGPT complex have lagged, and recent results have split the field, with Salesforce posting a strong AI-driven beat and over $1.4 billion in recurring AI revenue, while C3 AI delivered better near-term numbers but cut its full-year guidance and saw the stock sold off. Under the surface, financing this AI build-out is reshaping credit and rates. Credit default swap spreads for Oracle are at their highest since the financial crisis as markets question heavy debt issuance and AI-related exposure, while some allocators are taking a contrarian stance on investment-grade corporate debt, arguing that tight spreads, expected heavy issuance to fund AI capex, and fading duration tailwinds make the risk-reward less compelling. On the rates side, AI-driven capex is increasingly seen as inflationary for financial assets, because it pushes up borrowing needs and term premium even if the real economy impact may prove disinflationary over time through productivity and job automation. BlackRock expects long-dated treasuries to underperform into 2026 and is positioned underweight at the long end, citing rising term premium from AI capex and heavy bond supply, alongside an already steepening United States curve with 2-year yields below 3.5% and 30-year yields closer to 4.74. Against that, the bullish view stresses just how early the AI cycle is. Consumer usage is already broad, with around 70% of United States consumers using generative AI and a meaningful share now starting product searches with chatbots. Enterprise AI products from firms like Microsoft, Snowflake, and Salesforce are mostly less than a year old and expected to accelerate over the next 1 to 2 years, and investor appetite remains robust, with Anthropic preparing what could be a record AI IPO even as some managers, such as Goldman Sachs Asset Management, participate selectively and warn about bubble risks. The broader growth story is tilting more clearly toward an investment-led expansion, with AI, reshoring, and energy infrastructure at the core. Compared with earlier this week, when growth hopes were more conditional on rate cuts, the latest forecasts and data points lean more on real economy spending than on monetary stimulus alone. In the United States, there is now an official projection for GDP growth to exceed 4% next year, driven by large-scale construction, manufacturing expansion, and big tickets in AI and energy infrastructure. Near-term expectations still point to real GDP growth of about 2% this year, with AI-driven capital investment cited as the key support, and policy tools such as immediate expensing and full capital expenditure depreciation reinforcing business investment appetite. Europe shows a more mixed but improving picture. Services purchasing managers' indices remain robust, supporting consumer activity, while Germany is expected to run a fiscal deficit of around 4% next year, which is viewed as helpful for sustaining euro area growth even as German manufacturing stays under pressure and the region waits for a potential rebound. Corporate results are consistent with this gradual broadening of growth. Earnings beats from American Eagle and Inditex, alongside strong numbers from Salesforce and Snowflake, signal healthy demand in both consumer and enterprise channels, and companies like Raising Cane's are aggressively expanding their physical footprint in the United States and abroad, while the Athens Stock Exchange has been enjoying a revival with strong IPO activity and standout multi-year returns tied to more supportive Greek macro fundamentals. Rate markets are adjusting to this investment-heavy growth mix. The United States yield curve has continued to steepen, and some asset managers project underperformance for long-dated treasuries into 2026 as rising term premium and bond issuance tied to AI and infrastructure outweigh pure Federal Reserve policy effects, while others see tight investment-grade credit spreads as vulnerable given likely heavy supply and still elevated growth and rate levels. The counterview highlights meaningful risks to this acceleration narrative. AI overinvestment could erode returns and spill back into credit. United States manufacturing data are still weak even as investment rises. Unemployment is expected to edge above 5% by early 2026 despite fiscal support, and in Europe the cycle remains uncertain, with energy costs and geopolitical shocks having the potential to blunt the benefits of fiscal expansion and lower gas prices, so incoming data on Capex, labor, and upcoming earnings from names like HPE, Ulta, Dollar General, and Kroger will be important reality checks for the growth story. Geopolitics remains a slow-burning but powerful driver of risk premia, particularly through European energy security, Ukraine, and the evolving United States-China-Taiwan triangle. The mood compared with recent days is one of continued tension with little evidence that any single diplomatic track is about to deliver a clean resolution. On Ukraine, United States and Russian officials have described talks as constructive, but there is still no agreement on core territorial issues and negotiations have made limited progress, which effectively locks in a prolonged period of elevated risk for markets exposed to Eastern Europe. European leaders are also divided on how to deploy frozen Russian assets, with Belgium blocking proposals under a tight 2-week deadline, while at the same time political commitments point to structurally high European defense spending for the next 10 to 15 years, evidenced by large new contracts such as Germany's nearly €1 billion reconnaissance vehicle program that embeds advanced, including AI-enabled, battlefield systems. Energy policy is another crucial channel. The European Union has already halved Russian gas imports and agreed to accelerate a complete phase-out, with decisions pointing to an end of Russian gas purchases by 2027 and, in some plans, even earlier, which marks a structural shift in the continent's energy mix but also leaves European gas futures vulnerable to volatility as the bloc races to secure alternative supply and maintain price competitiveness versus global peers. In Asia, recently passed United States legislation requiring regular reviews of Taiwan engagement guidelines underscores bipartisan support for closer ties, even under Chinese pressure, raising the risk of renewed friction with Beijing. At the same time, trade tensions between Europe and China are mounting, with France pushing to avoid retaliatory tariffs on pork and dairy while China signals it could leverage its dominance in critical minerals and rare earths in negotiations, keeping supply chain and tariff risk firmly on the radar for European exporters and global manufacturers. Institutions are trying to adapt leadership and governance to this more complex environment. HSBC's appointment of an internal candidate, Brendan Nelson, as chair points to a preference for continuity and a less interventionist style that may give management more room to navigate geopolitical crosswinds, while analysts warn that repeated government shutdowns in the United States, even if they have limited long-term fiscal impact, can erode confidence in American governance and, over time, weaken its geopolitical standing. Looking ahead, the main watch points are whether Ukraine talks move beyond the current stalemate, how quickly Europe can operationalize its energy transition while managing price volatility, and whether United States-Taiwan policy changes trigger a sharper response from China in trade or security terms. For markets, this backdrop argues for ongoing attention to energy-exposed sectors, European and Eastern European assets, and defense and critical mineral supply chains, as geopolitical shocks are likely to arrive in bursts against what is otherwise a gradually evolving security and energy landscape. To wrap up, AI remains the dominant macro force, but the focus is shifting from pure growth excitement to the harder questions of capital efficiency, credit quality, and term premium as the Capex boom collides with low near-term returns. Growth expectations are firming, especially in the United States, where forecasts above 4% next year anchor on sustained investment and supportive policy, even as manufacturing softness and labor risks keep the path uncertain, while in Europe fiscal support and cheaper gas help but do not fully offset structural headwinds. Overlaying all this is a persistent geopolitical risk backdrop, from Ukraine and European energy decoupling to United States-China-Taiwan tensions, which continues to shape defense, energy, and supply chain exposures across portfolios. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.